Hi everyone, Mike Sukram here. I'd like to introduce you to my colleague, Leslie Crawshaw.
Hello everybody, nice to see you.
Leslie works with a number of advisors here with insurance strategies, which is very important to your financial well-being. As you know, I focus primarily on the investment side, so I thought it'd be important to team with someone who has an expertise in this area. So Leslie, would you tell us a little bit about yourself and some of what you do?
Sure. I've been in the wealth management field now for close to 9 years. And I was one of the first advisors in our office to get into the insurance aspect of the wealth management. And as a result, I now work with many of our colleagues, as you mentioned, to help them with their clients and their insurance needs.
That's perfect. Because as you know, I have a few clients who took out their policies many years ago, sometimes 10, 20 years ago, and these policies are coming up for renewal. So can you tell us why it would be important to review these policies today?
Of course. As you said, if they took these policies out 10 or 20 years ago, they were based on their needs 10 or 20 years ago. Now, typically people take out insurance when they get married, they have their first children, they buy their first house. They want to make sure that if anything happens to them, their family is going to be okay. They want to make sure their mortgage is paid off, they want to make sure there's money for their kids to go to school, and they want to make sure there's an income stream if they're not there to provide it. So this is typically when people buy their insurance, and then 10, 15, 20 years go by, and the insurance is coming up for renewal if they bought a T20, which is typical, standard for someone starting out. And of course, the insurance is based on that need that they had 20 years ago when they were just starting out. And at this point in their lives, things have most definitely changed.
You're absolutely right. Now, some of my clients, they are renewing and they are looking at whether or not they should renew. They're questioning if there's a need for this insurance. Can you tell us some of the things that they should consider? Some of them have heard about permanent solutions. Can you touch on that a bit?
Right. Well, as you said, they're coming up for renewal. They don't have to renew the same policy they had. They can renew it, or they can look at a different product, if you will. Term insurance is exactly that. The premium stays the same for the named term in the policy. If you have a term 10, premiums stay the same for 10 years, then just like a step ladder, it goes up, and then it's the same for another 10 years, and then it goes up again for another 10 years. Term 20, same thing, but 20 years, up for 20 years, up again for the next 20 years. Now, that typically is the most cost-effective insurance when you're young because you're only paying for the insurance at your age.
Now, I'm glad you brought it up, because although we're talking about permanent solutions, we were speaking about earlier the sticker shock that most people get on renewal.
Yeah.
Why is the price? Why is the renewal price so high?
Yeah. Well, when you take out a term 10 insurance, for example, say you're 30 years old, that premium is to cover if anything happens to you between ages of 30 and 40. Now, it's not likely that you're going to
kick the bucket at that time, right?
Exactly. Exactly. So within those 10 years, the cost of insurance is very low. But of course, as you age, life happens. Medical issues come up, things happen. You're getting older, and the company has guaranteed that you're going to have this insurance no matter what happens to your health. So even if your health does decline, you're guaranteed to have this insurance. So the company is giving you a standard rate the first time you buy it, of course, providing that you are healthy.
Meaning that the rate is based on good health at
Exactly, right. But they know that 10 or 20 years when it comes up for renewal, you may not be in standard health anymore. You may have a health issue. So the rate that they're giving you is the rate at your age in the future, 10 or 20 years down the road, and most likely at a substandard rate, not a standard rate of insurance.
In other words, they think that you're at the worst health
Right.
basis at that time,
Well,
right?
it's not that they think you're going to be that, but they're guaranteed to give you the insurance
Or
even
just in
if
case.
you are.
Right, okay.
So what you're better off to do, rather than just accept the renewal rate, is if you're in good health,
Mhm.
is to get a new policy where you could be rated at a standard rate instead of the inflated rate that the insurance company is promising you.
Mhm.
But I would actually caution you to, at that time, take a look at the need and see if a term insurance is what you need anyway.
Mhm.
As we said, when you're starting out, your needs are to cover debts, liabilities, make sure there's an income stream there.
Mhm.
20 years later, you may not have the same concerns. You've probably paid off or at least paid down significantly
That's
your
right.
mortgage.
Mhm.
Your kids have gone through school or they're well on their way and the money's saved up there for them. So your needs now are quite different, and you're probably looking more at estate planning than you are at debt recovery, right? Or
Mhm.
debt,
That's right.
cash flow issues.
We were talking about this earlier, so we're kind of jumping from place to place. But some of my clients have done all of that. They've reduced their debt significantly. They're closer to retirement. Life has changed.
Yeah.
Now, some of them have inherited money. Some of them have become business owners. How?
And some of them have bought rental properties.
Yes,
rental
yes,
income
yes, that's
properties.
right. So,
Yeah.
how would their insurance needs be different in this case?
Okay, well, like we said, when you're looking at paying off debts, you know how much money you need to pay off these debts. Today, you're looking at estate planning, so you need to have an idea of what your tax liability is going to be upon death.
Mhm.
You want to look at, if you have a corporation or a trust, you could actually look at shifting the cost of the premiums out of your own personal cash flow and into the cash flow of the corporation or the trust.
Mhm.
Also, what would happen then is you'd make the corporation or the trust the beneficiary of the plan, so the insurance benefit goes to the corporation, and then you have much more flexibility in how and when you pay out the money to the beneficiaries.
Mhm. Now, I think you guys probably clued in. We probably could get really deep into this discussion. Pretty exciting stuff for us, but probably boring for you. But I would suggest that you review your policies because it just makes absolute sense. Now, Leslie has offered to do this for my clients, and I would highly encourage you to take up the offer. So pull out your policies and let's get a summary of what these things are. We're going to send you a questionnaire, and Leslie's probably going to contact you a little bit later. All right, so I think you're going to be in really good hands, and I think you will save a lot of money, or certainly get the right type of insurance in place if you need it. So I just want to close off this video quickly. Leslie, is there anything else you'd like to add?
I just want to say thank you very much for inviting me to your video shoot. And I look forward to meeting any of your clients who are interested in making sure that their insurance is the right fit, the right amount, the right type of insurance, and I look forward to working with you.
Okay, fantastic. Okay, folks, that's a wrap. We're gonna contact you soon. All right, so I hope you enjoy the rest of your day, and thank you so much for watching this video. Okay?
Bye.
Bye.